Hi everyone. I just want to let you know as you start to file in, these first few rows are reserved for Hill staff, so if you'd like a better seat, feel free to come up here.
where if you're at the symphony, this is where they clap for the right? How we doing? Welcome, everybody. Great to see such a tremendous crowd coming out, and we got saved some spaces for congressional staff up here. Look forward to having them come in. I'm Scott Hodge, President of the Tax Foundation. I'd like to welcome all of you to our panel on Talking Taxes, Cash Flow Taxes, Border Adjustability in U.S. Companies. And I especially want to welcome all of those folks at home or in their offices who are watching our live streaming. I don't think they can fully appreciate how beautiful this room is, that we're here at the Visitor Center of the U.S. Capitol. This is truly a beautiful room, and it's a pretty special place. And thanks to Congressman Peter Roskam and his team for helping us to reserve this room. We had overflow capacity in a smaller room just down the hall, and so we had to expand at the last minute, and Congressman Roskam was kind enough to do that. I do want to let folks know there are press in the room, so please don't tweet nasty things Sean Spicer-like at them. I don't know if anybody watched that Saturday Night Live skit. They told me that this podium is nailed down just so that I can't do anything untoward our friends in the Fourth Estate. I especially want to extend special thanks to our partners at Intuit's Tax and Financial Center who are sponsoring this program and who have worked so hard to help us put the arrangements together. This is the first of our Talking Taxes series of educational programs that the Tax Foundation and Intuit's Tax and Financial Center will host over the next couple of months in our effort to raise the level of informed debate about tax reform. You know, by all accounts, it appears that the stars have aligned for a once-in-a-generation opportunity to overhaul the U.S. tax system. And right now, the main proposal on the table is the GOP Better Way blueprint that was designed by Speaker Paul Ryan and Ways and Means Chairman Kevin Brady. And, you know, while the most talked about part of this comprehensive plan, and it is a comprehensive plan, we have to remember that, but the most talked about portion, as you know, is the transformation of the current corporate income tax into what's known as a destination-based cash flow tax system. And to all of you Twitter followers of Richard Rubin at the Wall Street Journal, it is now just simply known as hashtag DBCFT for short. That just kind of rolls off the tongue, doesn't it? DBCFT hashtag. Unfortunately, much of the debate over this proposed new system has involved arcane economic theory about currency adjustments, a lot of misunderstandings about who will bear the burden, and in some cases, some outright hysteria. But what's been missing from this debate is an impartial, empirical assessment of how a destination-based cash flow tax, I just need to use the acronym DBCFT, would actually work. How it would change the corporate tax base, and how it would affect the finances and tax burdens of U.S. companies. And this is what makes the most recent working paper from the Office of Tax Analysis at Treasury so timely in this discussion. And what's really interesting about this study, and you'll hear about it in just a second, is that the work on it was begun more than a year and a half ago, long before the House blueprint was released. So this is an issue that has been interesting to academics and economists for some time, and we're glad that this study is out in such a timely manner. As you'll hear in a minute, economist Elena Patel and her co-author John McClellan ran microsimulations based on panel data of actual corporate tax returns in order to give us a better understanding of the strengths and the weaknesses of this type of tax reform. This is the kind of impartial, empirical research that lawmakers need as they consider moving forward with this type of tax reform. And our panel today won't address all of the questions I'm sure many of you may have about cash flow taxes and border adjustability, but I think we'll get a very thoughtful and honest discussion of the issues that are facing lawmakers today. And I'm very pleased to have Elena Patel here today to present the findings of her study. She is a financial economist at the Department of Treasury's Office of Tax Analysis. She holds a Ph.D. in economics from the University of Michigan and has worked at the Department of Justice and Congressional Budget Office. She's also an adjunct professor at George Washington University. And following Elena's presentation, you'll hear from two of the most published tax economists working in Washington today, Douglas Holtz-Eakin and Bill Gale. They will provide comments on the study and talk about its significance to the current debate, and then we'll have a little Q&A from you. As most of you know, Douglas Holtz-Eakin is president of the American Action Forum, former head of the Congressional Budget Office, and former chief economist at the President's Council of Economic Advisors. Bill Gale is equally well known as the co-director of the Urban-Brookings Tax Policy Center, and where he is the R.J. and France Fearing-Miller Chair in Federal Economic Policy at Brookings. He was also a senior economist at the Council of Economic Advisors under President George H.W. Bush. And please welcome Elena Patel to start off our program today.
Yep. See if I can get the clicker to work. There we go. Right. Hi. I just want to thank the Tax Foundation for arranging this event. It's always nice when something that you work on gathers a little public interest. So this is a project, like Scott said, that we've been working on at Treasury for quite some time. So that's going to explain the change in affiliation for my co-author, John McClellan, who's now at the Congressional Budget Office. But while he was at Treasury, he worked with me and several people in the office on this project. The disclaimer that's necessary here is that this is not work that comes out of Treasury or CBO. These views and opinions are mine and my co-authors, so don't call the press office over there. But what this paper is going to do is it's going to look at a cash flow tax. We set it up sort of in the overarching theme of economics, but the goal of the paper is to get down to a micro simulation and look and see for a historical panel of firms what this movement to a border adjusted cash flow tax would do to the tax base. So it's to provide some empirical evidence. Obviously, right now, this is a hot topic for policymakers. So currently, policymakers have expressed a clear interest in reforming the US tax system. What are we looking to do in reform broadly? Simplification. I think everybody can agree that the US tax code is a complex animal, and so to the extent that we can simplify it, that's definitely a goal of tax reform. From a macroeconomic perspective, we would like to improve incentives for investment and growth. I think that's broadly always a policy goal of the US. And then in particular, in the recent decade and a half, we've been thinking hard about location decisions. We want to minimize those distortions to the extent firms want to move money or profits offshore. So the truth is that if there was an easy fix for this, it would have been done already. And so because there's not an easy fix, it opens the door for sort of broader reform options to be considered. And so the goal of this paper is to put some numbers to that, to think about a historic panel and look at how the tax base changes for a 10-year period. So why do we think about a cash flow tax? That's not the only option out there. This is an old question for economists. You can trace some of the terminology back to the Meade Commission in 1978. It's something that we've kicked around at Treasury, in an informal and formal capacity. Most recently in the 2005 panel on federal tax reform. This was part of that package of things that was considered. When you want to think about the goals we were trying to get to, one was simplicity. So income is broadly difficult to measure and subject to a lot of gaming on the part of corporations. So cash flow is a simpler way to go. And then the idea would be eventually that all businesses and not just corporations would be taxed under this system, although what we're going to consider right now is just going to be subchapter C corporations. Cash flow tax with a border adjustment should ease location choice pressures. So there are a lot of resources spent on the firm side attributing income, and this can lead to things like transfer pricing and the incentives and games that are associated with that. And then if you want to think about increased incentives for investment and growth, one of the problems with the current tax system is that it subsidizes debt over equity. So something like a cash flow tax would equalize the treatment of those two. And then in particular, something again, that's become a little bit hotter in recent months, is thinking about the return on investment when you separate it from a normal return and a super normal return, and a cash flow is going to exempt the normal return from investment. So that's a lot of economics talk, but it gets to the issue of progressivity. And so if you tax supernormal returns, you might be moving towards a more progressive tax base. So the truth is, like I said, we've been thinking about this as economists for quite a long time, but there's really a lack of real-world experience with the cash flow tax, which is probably part of the inertia towards moving towards something like this. So what we're going to do is specify an illustrative prototype. So I want to emphasize that we're not trying to model any particular plan or proposal. We just tried to come up with a basic cash flow tax specification. And then we're going to do something called a microsimulation. And we take a historical panel of tax returns, and we move the dollars on the tax return from an income tax to a cash flow tax base. And then we think about the impact on the base and on the firms in particular. Who are winners, who are losers, how are firms moved around as you move between the bases. Okay, so just if you're not familiar with the cash flow tax, I just want to go through the basics of it. So what it is, it's called a flow of funds tax applied to net receipts accruing to a given business. So that's a lot of words, but you basically want to think about it like a bank statement. And so you're measuring the cash going into the business and the cash leaving the business. And at the end of the year, if you had the bank statement, you would have the flow of funds. And so the idea is just to tax the money that's in the corporation. The base can be defined in two ways, and again, this goes back to the Meade Commission and the terminology. So there's an R base and an R plus F base, where the R stands for real and the F stands for financial. So in an R-based cash flow tax, you would ignore transactions that involve financial assets and liabilities. So loans between banks and businesses would be ignored in terms of payments and repayments. Or you could move to an R plus F base, which is the most comprehensive, and from a simplification perspective, maybe something you might want to consider, where all cash inflows, less outflows, would be included in the base. So it's a question of how you're going to treat the financial dollars sort of moving back and forth. Economists will tell you that this is economically equivalent to the destination-based value-added tax, so a VAT, but with a deduction for labor. And it's useful to think about that when you're thinking about this sort of in broader WTO compliance, which we're not going to opine on at all, but this is to give it a comparison to what is out there. In practice, it's administered pretty much like the corporate income tax, but there are a few major adjustments that happen. One of the biggest is the full expensing of tangible assets, investments, and inventories. And so what that means is right now firms are depreciating assets according to a depreciation schedule. Some of the complication in the code comes from the depreciation schedule itself. In a cash flow tax, if you buy a building in a given year, you write off the entire cost of the building in the given year. It's not depreciated over the life of the building. The same goes for computers. So any kind of investment that you're making, you write off the full cost in the current year. The border adjustment piece removes foreign sales and purchases from the tax base. And this is where a lot of the talking points have come up in the recent weeks, is what the border adjustment is going to do. In the R base, which is what we are going to specify, you exclude interest, incomes, and deductions. So this is where the tax code leans on debt, and so you can deduct debt payments and you're taxed on interest income. In the R base, that's removed from the system. In an R plus F base, you would think about it differently. And then I just want to point to two papers. There's an Auerbach paper in 2010 and one that just came out with Auerbach and some authors that really walk through a theoretical cash flow tax and what is in and what is out and all of the, again, incentives and economic underpinnings of those plans. And so that's a really great place to go look for what a cash flow tax is. So what is the border adjustment? This is, again, something that people are thinking very hard about right now and what its implications are. So in a destination basis, what we take is the domestic sales of goods and services, so everything you buy in the US, less the domestic expenses incurred. And so what this means in particular is that purchases from foreign parties are no longer deductible. So if you're importing pieces to your production process, you don't get to deduct those costs in a border adjusted cash flow tax. And then sales to foreign purchasers are no longer taxed. So if you bake a loaf of bread and you sell it in Canada, you don't get to deduct the cost of tax. And why am I talking about baking? Because I have an example here. Just to get everybody on the same page about what's going on. So in this economy, there's a farmer, miller, and baker. And so the farmer, say, buys its seeds in Canada. It sells its goods to the miller. Oh, not clicking very well. Okay, so the farmer is going to take the seeds, grow something, sell them to the miller. The miller buys them domestically and then sells the flour to the baker. So the baker is buying all of its inputs domestically, but then the baker sells some pieces of its process in the US and then say some in Canada, okay? So we can look at what happens to the miller. Remember, the miller did everything in the US in this example, and so there's no change in their basis from a cash flow tax to a border adjusted cash flow tax. They're totally unchanged. What you want to think about is the farmer and the baker. So for the farmer, he bought the seeds, say, in Canada, and he normally deducts those from his taxable income and ends up with a cash flow base of $100. We're going to deny the deduction, and so we've increased the taxable income of the farmer. So his liability is going to be bigger for the same rate with the border adjusted cash flow tax and with the cash flow tax before border adjustments or an origin basis. And then the baker, we haven't increased his tax liability, we've actually moved him into a loss position because we removed from the tax base the bread that he sold to, say, Canada. So you don't you don't tax the $300 of income, and we move him into a loss position. And so what we're trying to think about in this paper is how many farmers are there and how many bakers are there in the US system, because how you treat those under a destination-based cash flow tax is going to affect what the impact of the cash flow tax is. Okay, so some things to focus on and what we tried to focus on in setting up the microsimulation. The first is how comparable the tax base is. So the size of the tax base is going to dictate what kind of rate you can impose for some revenue goal that you're trying to achieve. So does the tax base get bigger or smaller when you move to a cash flow tax, and what happens to the tax base when you do the border adjustment? Secondly, as in the case of the farmer and the baker, we want to think about how to treat losses. Okay, so tax systems broadly face a trade-off. There are firms that are on loss under the income tax, and so there's an economic benefit to refunding those losses for businesses, but there's also a distaste for writing a check to firms from the government. And so what we have right now is sort of a compromise where firms can carry losses backwards and forwards. They don't get a check from the government. And then finally, when you're thinking about the explicit border adjustment versus an origin-based cash flow tax, we want to think about what's happening to the firms. How many firms are impacted by the imposition of the border adjustment, and what kind of losses are caused particularly by the border adjustment? So we'd be worried about exporters, for example, like the baker who's sending goods out of the country and has moved into a loss position, and what that does to their incentives. So in our simulation, the goal is to compare the cash flow tax base to the income tax base that was in the United States. So what do we assume? And that's important to keep in mind when you're looking at the results. We assume immediate transition between steady states. And so we don't assume that you take time to depreciate old capital. It's just if we were to drop firms in a 10-year period into a cash flow tax with all the adjustments that would come, we move to a new steady state, and we assume that happens immediately. We also assume there are no behavioral responses by the firm. So in this way, this isn't a realistic picture of what's going to happen, but what it's going to do is sort of highlight the incentives that come from moving to a cash flow tax, because you can see where things look a little bit funky. We abstract away from the cost of transitioning between the two systems on purpose, because that's a big question and a separate question. And what we wanted to focus on was the fundamental differences between the two bases. And so we want to think about the relative burden. We want to think about the cyclicality of the bases for fiscal planning purposes. You would need to know if you're moving to a more volatile tax base. And then we want to characterize the impact and role of losses, because that's going to be an issue to deal with when you talk about transition. So on the microsimulation, what we did explicitly is we created a 10-year unbalanced panel of firms from the IRS statistics of income. What they do is they do a stratified random sample of actual corporate tax returns. They reflect the initial filing. There's no carrybacks. It's about 110,000 firms. And we take them from 2004 to 2013. And then we take their income tax statement and we take the steps necessary to move their income tax to a cash flow tax. So there are some caveats to using historical panels, which are really important to keep in mind, again, in interpreting the results. The first big one is that any policy decisions that were undertaken between 2004 and 2013 are going to be embedded in the data, and the firms are going to have been responding to that. So for example, there's bonus depreciation going on. Bonus depreciation allows for a set of capital immediate expensing, much like what we're talking about moving to a cash flow tax. So firms are already, in a sense, responding to the incentive for immediate investment or immediate expensing for particular kinds of investment for all but 3 years of this period. And so that's going to make the bases look a little bit similar because the policy is baked in there. Another very big one to keep in mind, we have the macroeconomic business cycle in the background. So there was a big business cycle that happened between 2004 and 2013. The Great Recession is going on here, and any responses to that and the impacts of the firm, which you might think are atypical relative to a normal business cycle. So again, that's going to be embedded in the results that we find. And then finally, the data that we have is limited to what's reported on the tax returns. So that means when we want to do something like a border adjustment, we don't have the data to separate the income statement between domestic and foreign, so we have to impute that, for example. It also isn't well suited to identify financial transactions. But it's not all doom and gloom. There's a reason we did this. There are a lot of advantages to using the microsimulation on the historic panel of firms. So because we're using microdata on actual firms, we can look at who the winners and losers are. Again, how many farmers are there and how many bakers are there when you move to this new system? In aggregate data, you can't see the actual firms, and so you can't count these things up in some sense. But because we're using firm data, we're able to do that. So the microdata is allowing for the evaluation of things like timing effects, responses to the business cycle. Again, we're thinking about the volatility of the tax base. And then the number and types of firms of what's called that are in perpetual loss. Perpetual loss means they always look like the baker. Their taxable income is always negative and they never move out of it. We focus on the R tax base, so that's important. There's a question when you're designing a cash flow tax if we're going to do an R base or an R plus F base. So because our time period spans the Great Recession, there are some funky things happening on the balance sheet for a lot of firms in very particular industries. And again, because the tax data is not well suited to really separate the financial flows out, we think about the R base, and then we exclude the financial industry from our analysis. So this is for all firms but financial firms, and it's an R-based tax. If you look at the Auerbach paper, he talks about business-to-business transactions between firms. There's an equivalence between the R and the R plus F base. What you need to worry about are firms that are making loans directly to consumers, and then you need to explicitly deal with their income statements and how to separate those transactions. So, okay, so this is the border adjustment. So this is the big, I think it's a leap forward in what we've done, but I will tell you it's not perfect because the data isn't available to do this explicitly. Again, the tax data doesn't allow for the identification of domestic versus foreign flows. So what we have to do is we have to impute the detail to get the destination-based cash flow tax. So we do take some information from the tax returns. We take whatever we can get, basically. On the 1118 and the 5471, you can see related party transactions. So that allows us to pick up particular kinds of imports and exports, but certainly not all of them. And so we also take data from the census. And the census breaks down imports and exports by firm size. And this is a departure from everything that was done in the past, because you see in the census tables that the firms that are doing the exporting are the largest firms within the industry. And so if you apply imports and exports to all firms, that's not really a great match to the current state of the world. You also see that the firms that are exporters also tend to be importers. So again, remember with the farmer and the baker, I had one firm that was an importer and one firm that is an exporter. But in the US data, it looks like the firms that are exporting are also importing. And so we impute that detail onto the tax data in order to do the destination-based cash flow tax. But what you'll see is a reflection of the way that we did that imputation because we can't identify that exactly. So just to show you what the tax bases are looking like, the gray line is the income tax. So that is our current income tax base from 2004 to 2013. The green line is the cash flow base before border adjustments. I want to emphasize a couple of things here. So that's like an origin-based cash flow tax. This is before we've done the border adjustments. We don't think about credits and losses here. This is just measuring the tax base itself. So there's a very big wedge, actually, between taxable income and then the taxes you pay. There's as much as a 50% offset that comes from things like foreign tax credits and general business credits. Those are policy tools left to the policymakers. We're just measuring the tax base. And what you can see when you compare the gray line and the green line is actually the cash flow base, the origin-based cash flow base, and the income base are not that different. Okay, the cyclicality looks roughly the same. They're not moving very differently. And so this is actually, so I've been staring at this for a long time, so I've sort of internalized it, and I have to remind myself it's a surprising result. To people that are worried about moving from an income tax to a cash flow tax, it's surprising that the bases look similar. Recall underlying this is, all but 3 years worth of bonus depreciation. And so some of the big movements actually are in the background here. And so that's probably bringing the bases closer together. But a result of the microsimulation shows that the cash flow tax base and the income tax base by themselves are actually not all that different. The big change is coming when you do the border adjustment. So that's the blue line up top. So the US in this period was a net importer. For a net importer and we deny imports from the tax base, we're going to raise money. Again, it's just an artifact of the fact that during this period we were a net importer. And so you can see here that we had $9.3 trillion in taxable income during this period. The cash flow tax before adjustments, again an origin-based cash flow tax, is only about 1% different over the 10-year window, although there are year-by-year differences. But when you move to the destination-based cash flow tax, you get an increase of as much as 50%. Again, why is that coming? That's coming because in this period we were a net importer. So then, because we've got the microdata, we need to think about what's happening with the losses, because this is one of the pressure points that policymakers in particular are very worried about when you move to a totally new cash flow tax system. And so the microsimulation lets us compare the fraction of firms that are in loss, sort of under the income tax and under the cash flow tax. In 2012, under the income tax, 45% of firms by count, but 20% of firms, when you weight them by assets, were in a loss position. So the weighting them by assets is important because although there are a lot of firms, not so many of the firms pay the tax revenue. So 20% of firm assets were in a loss position. And then, like I said, because the base of the cash flow is not so different from the income tax, you get very similar numbers when you compare the two. However, when you move to the destination-based cash flow tax, while the number of firms has not changed very much, as in percent of firms in loss, 42% of firm assets are now in a loss position. So that's quite a big expansion relative to the income tax base, which means that we need to think more about this. I do want to highlight that annual figures by themselves are probably not the best way to look at this. There's a natural churn in income. Firms do move in and out of loss just as a consequence of the business and when their income is measured. And so what we want to think about is actually in an aggregate sense what's happening to these firms. We haven't assumed any policy towards losses. The current policy lets firms carry back losses 3 years and forward, I think, 20, and so they can move them back and forth, although not indefinitely and without interest. What we're going to do is net each firm's tax base over time. So we're going to sum up their taxable income every period. And that way we're mimicking this. We're letting them use losses in previous periods to offset gains in future periods. And then we're going to think about the impact of an alternative treatment of loss. Again, economists would tell you that you should fully refund this to get the right incentives in the system. And so we need to think about what the difference is. So evolution of firms in loss. What this table is showing is that if firms move from the income tax to, on the left, we have just the cash flow tax, the origin base with no border adjustment. And on the right, we have the destination basis. And what we're trying to figure out is take a tally of firms that were taxable in aggregate in the income tax that remain taxable in the cash flow tax or in the destination-based cash flow tax. You have your hashtag built into the table, so you're good to go. So 46% of firms in the income tax that were taxable stay taxable when you move to a cash flow tax, and that's roughly the same story that's told in the destination basis. We're trying to think about the firms that were moving into loss, like the baker, when we move to this new system. So you can see the off-diagonal is what we're worried about. We're worried about the firms that might have been in loss that were moved to a taxable position, like the farmer, and vice versa, the firms that were taxable that moved into loss. So as I alluded to in the census data, it does indicate that there's concentrated cross-border activity. So there is going to be heterogeneity by firm size in these tables. So for example, for the largest firms, 73% that were taxable stay taxable. So we're not moving many of the big firms into loss. But there's still 10% of firms that do move to a loss position because of the change in tax base. And again, you need to be aware of that when you're thinking about the design of the cash flow tax. What do you do with those firms that used to have a tax liability that now are moved into a permanent loss position? And again, permanent loss means when we sum the taxable income over the 10-year period, they never become taxable. Their losses are so much that they don't offset their taxable income. Okay, and so now I want to just think about the alternative treatments of losses since this seems like a pressure point and what can we do about this? So in column 1, we impose refundability of losses. Again, what the economics argument is there is to refund losses to get the incentives correct, compared to column 2, which is carrying losses back and forward as we have in the current system. And we want to think about the difference in losses that are coming from these two different treatments. And so under an income tax, losses were 18% of the tax base, and under a destination-based cash flow tax, they're 24%. So we are increasing losses in a way that you might expect if you saw the little economy that I made up. And so we do need to decide what to do about the losses. And there's not an obvious and easy answer to that, but there are going to be firms that are moved into a loss position and more than under the income tax. Regardless of the treatment of losses, if you were trying to think of a revenue neutral rate, so raise the exact same amount of money between 2004 and 2013, that would give you a revenue neutral rate. You can see that the tax base, again, because we're a net importer in this period, is nearly 50% bigger. And so you can imagine that a revenue neutral rate would be considerably lower than the top rate of 35% that's going on right now. But I just want to keep emphasizing that that result is hinging on the fact that we were a net importer in that period, and that's important to keep in mind. Okay, so the truth is that in the real world, there's no experience with a cash flow tax. And so while policymakers are interested in this, we find, if you read any of the opinions, it's hard to imagine how to move to this because there's no empirical experience to lean on. And so what we try to do with this paper is to bridge the gap a little bit, to think about if you move to a steady state, what are we doing to firms? Because that's going to indicate where the pressure points are coming from. How are firms likely to respond to this cash flow tax? So we find the destination-based cash flow tax would have been significantly larger during this period, that it's a little bit less cyclical, and in aggregate, it's not moving the majority of firms into loss. But there are certainly firms that are moving into loss in a perpetual state that need to be addressed. There are some things we left out. Again, important to keep in mind when you're trying to interpret the results. As I said, we punted. We left out the financial firms. We didn't think about the R+F base. That's going to be a hairy problem if you're trying to think about what the appropriate way to tax financial firms is. And then another big goal of tax reform might be to think about how to tax pass-through businesses like partnerships and S corporations, and we do not have them as this calculation. This is just subchapter C corporations. So this isn't going to shed light on how their tax base may move when you go from an income tax to a consumption tax. We showed that careful consideration should be given to the treatment of losses and credits. So there's an increase in losses that are coming under the new system versus the old. And so maybe the old rule of carry back and carry forward isn't the right way to go. Maybe there should be an adjustment to that. And then the elephant in the room that we're ignoring, again, we're going to punt financials, and we're also not going to talk about how you would transition from one to the other. So the design choices about transition and the economic effects of moving from an income tax to a cash flow tax are going to be very real, and something that is left to the reader to opine on. That's it.
Thank you very much. And now we'll move on to the comments, and we'll start with Doug Holtz-Eakin.
Well, thanks, Scott, and thanks for the chance to be here today. I want to congratulate Elena and her co-author. This is a really important moment. To date, there's been a really interesting abstract tax policy discussion going on in Washington that's been uninformed by any facts. And this is a fantastic contribution. I think you just can't overstate the importance of taking these worries that have pervaded the discussion, the scale, frequency, and duration of losses, for example, and getting some sense of it, looking at the nature of the tax bases between the two, and I just think it's a fantastic paper and something that everyone should take a look at. I do think that just staring at that difference between the origin cash flow tax and the destination-based cash flow tax, the tax base, just tells you why this is such a hot-button issue, right? That sort of the amount of revenue on the table in moving to border adjustment is enormous, and for that reason, it's going to attract a lot of attention. And I think the sort of really interesting question, I actually have one very minor question I was curious about. So at the moment, we've got the clear incentives for transfer pricing abuse and other things to do profit shifting. Under the border adjusted cash flow tax, those incentives disappear. So how should I think about that relative to your simulations? Does this understate the domestic tax base?
I mean, because it's behaviorally static, it naturally understates.
It understates,
the results there.
So I guess the next step would be to, this is the standard reward for doing really good work. People ask you to do something even harder. And what I think would be really interesting is to sort of move from this calculation. This is the calculation that the tax department and every major corporation did the moment the House blueprint came out. They sort of said, what will happen to our taxes? And that's not really the right calculation. The right calculation is, what will happen to our after-tax profits in the presence of this reform and in the absence of this reform? And you can inform that discussion well. It's a different question, but there is some combination of faster economic growth and currency appreciation which would hold a firm harmless in terms of their net income, and some will benefit. And knowing the range of those responses is actually, I think, very important for the debate, because in the end, most of the debate about tax reform is the question, how can we have better economic performance, and how dramatically do we have to change the tax treatment of our major companies and our pass-through entities in order to achieve that performance? And that's the central question. What's come from that, at least in the House proposal, is this destination-based cash flow tax. It'd be interesting to see if in the presence of the kinds of responses the authors of that plan are hoping for, we get answers to these questions that look very much palatable, and there aren't chronic problems with losses and things like that. So I think that's really the next step, and I just can't thank Elena and John enough. This is a fantastic contribution. Bill.
Thank you, Doug. And we'll move right on to Bill.
Well, I agree completely with Doug. I want to thank Scott for inviting me to this, and congratulate Elena and John on a really excellent paper that I think speaks testimony not only to how taxes, how information and economic research can inform policy debates, but in particular how government economists working with the data they have access to can make unique contributions to the policy debate. So this is an excellent place to start a discussion of the cash flow tax because more information, especially on a tax that's never been implemented anywhere in the history of the world, more information is always helpful. So let me just make a couple of points. The destination-based cash flow tax is a really elegant and simple system. As Elena described, it solves a lot of the problems that people have with the current corporate income tax. And I'll note at the outset too, it's not a partisan proposal in the traditional way that we think of partisan politics. The rest of the Republican blueprint is it cuts taxes for high-income people, et cetera. And we get back in the debate with Reagan and Bush cutting taxes and Clinton and Obama raising taxes at the high end. This is not that. This is not a traditional supply side proposal. This is a proposal that has, I think it's fair to say, nonpartisan roots. And it presents some very interesting issues in tax policy. One way to think about this proposal, just to shake things up a little bit, is it essentially makes the government a shareholder in a corporation in every business in the country. The government shares all the losses and it shares all the profits.
What are you trying to kill it?
There are many ways to describe this thing, and that's one of them. I want to raise a couple of issues. The first thing is there's a little bit of a bait and switch discussion about the tax rate. We know why we want to cut the corporate tax rate. It distorts investment choices, as Elena said. It distorts financing choices, preferring debt over equity. It creates these incentives for all these international tax arbitrage schemes and transfer pricing and intangibles and all that. The cash flow tax doesn't do any of that. It doesn't distort investment. It doesn't distort financing. And it doesn't one of the most amazing things about it is it solves all these international tax avoidance things through the simple expedient of simply ignoring international transactions. I wish I'd thought of this when my kids were young. It would have been a great parenting strategy just to ignore bad behavior and see if it just went away. But in any case, all the transactions that people can do to move tax liabilities overseas, they could still do them in the cash flow tax. It just wouldn't affect their liabilities. So it's a really amazing proposal in that regard. But precisely because it does not have all those distortionary effects, the usual arguments for why we need to reduce the corporate tax rate don't apply to the cash flow tax. If something is non-distortionary, you should tax the hell out of it. As a basic principle of tax policy, there's no deadweight loss associated with it. So there's a little bit of a disjuncture between the notion that we need to move to a cash flow tax and we need to reduce the tax rate. We need to do one of those, or maybe we need to think about those two margins, but we certainly don't need to do both of them. The Tax Policy Center estimates that the revenue neutral rate would be about 31% over the next 10 years. But that understates it overstates it because it does not include behavioral effects, but it understates the rate because it includes the revenue from imports. It's important to realize the revenue from imports is temporary. Over the long term, the present value of exports has to equal the present value of imports. And so our trade deficits eventually will turn to trade surpluses. And at that point, the cash flow tax will lose money, not raise money. So the Bush Tax Commission in 2005 actually proposed something very close to the destination-based cash flow tax, but they left out the revenue from the border adjustment, which is over $1 trillion over the next 10 years. They left it out on the political grounds that the WTO might reject the border adjustment. I'll talk about that in a second. but also on the grounds that this was not revenue that was here in the long term. This was taking revenue from the future and moving it up to the next 10 years. So if we financed, say, revenue neutral tax reform with a border adjustment, then after the 10 years, we would lose money from the rest of the reform, and we would lose money in the future from the border adjustment too. So there's a really important timing aspect of the border adjustment that needs to be front and center in all this. All right, let's talk about the WTO. The WTO is certain to reject the destination-based cash flow tax as incompatible with its rules. The reason is the WTO says you have to treat your imports the same way that you treat domestically produced goods. And what the cash flow tax does is it taxes the full value of imports, but it doesn't tax the full value of domestically produced goods. It only taxes it deducts wages. Because it's a value-added tax, it avoids taxing the normal return. So it only taxes the supernormal returns to capital. And so it's only taxing one small share of the domestic good, but it's taxing the whole it's taxing the whole value of the imported good. So the WTO is going to reject that. Let me issue the caveat that I'm an economist giving a legal opinion, but I will say that every lawyer I've talked to has said this is the case. Now you could solve this problem by splitting the cash flow tax in two. As Elena mentioned, the cash flow tax is a value-added tax with a wage deduction. And the way you split it in two is you just have a value-added tax, and then you subsidize wages somewhere else in the system. So the system that would work would be a standard European credit invoice value-added tax, and then we go to something like a payroll tax deduction or a credit for payroll taxes paid or something like that, or expanded EITC, you might think of it that way. There are ways to get wage subsidies into the system without sticking them into the corporate tax. But we would have to think about something like that. If I have time to make one last point, that the whole impact of this, or not the whole impact, much of the impact of the cash flow tax, particularly border adjustment, depends on how exchange rates adjust. If exchange rates adjust 100% for the tax, then everything's fine. There's no change in the trade balance. There's no increase in exports. There's no reduction in imports. Importers are not hurt because the exchange rate went up by as much as their tax went up. So the Walmarts and the oil refineries of the world don't need to worry. There are two things that happen though if the exchange rate adjusts fully. One is there's a big transfer of wealth from Americans holding wealth overseas. Unless you think that's not you, let me suggest you look in your 401k account and see what proportion of your assets are invested in overseas funds. So it'd be a big transfer from Americans holding assets overseas to foreigners holding wealth here. And this could be an enormous transfer of wealth. Americans hold $24 trillion overseas. Foreigners hold 30-some trillion dollars here. Multiply each of those by 25%, take the difference, you get a number like $14 trillion. I'm not saying it's going to be $14 trillion, but it could be up to that. There could be a major transfer of wealth. The other concern, which may not be first order domestically, but is internationally, is that countries who are debtor countries who have their debt denominated in dollars, but their assets in their own currency, if the exchange rate rises 25 or 30%, they're going to be hit really hard. The Asian financial crisis in the 1990s had to do with exchange rate movements, and countries like Mexico or Indonesia, which have a lot of dollar-denominated debt, could be seriously hit. So what you say, well, maybe the exchange rate won't adjust fully. What happens then? Well, then the trade deficit comes down. Exports go up, imports go down. But then the concerns of the retailers and the oil refineries and the apparel industry, then they become more apparent. If the exchange rate doesn't adjust, then import prices go up and consumers get hit at the cash register. So this is not to say we shouldn't do it. This is to say there are a whole lot of things we need to think about. It's worth emphasizing this is a tax that's never been implemented anywhere ever. And so there's a lot of undotted I's and uncrossed T's. and I hope that people like Elena and Doug and I and others will start dotting those I's and crossing those T's. But there's a long way to go from a discussion of a paper to a legislative bill to actually enactment. So I think it's fair to say we're in the early stages of this discussion, and I hope it continues. Thanks.
That's terrific. Thank you. Actually, well, I do want to get to some of those questions, but maybe I'll start off with a question to Elena. Did you have any surprises from the results of your study?
I think I was most surprised by the similarity in the base between the income tax and the cash flow tax. So I had expected there to be a bigger wedge between the two. And so it's something we've thought about in the office. Why are these things looking so similar? Because you would imagine the immediate expensing of capital would drive that wedge. And so it's a historical panel, and so there's a lot of behavior built into the data that we can't unwrap in some sense. But I don't think it's a mischaracterization that the two bases actually do seem to be quite similar. And so that, I think, was the most surprising thing to me that came out of the study.
What surprises did you have, say, Bill? And
Exactly that.
Yeah.
Both of those. Essentially what that means is most corporate returns now are excess returns, and that feeds into the stories about increasing monopolization that we've seen in other contexts.
I thought there was,
yeah, go ahead.
I would say, yes, the tax base is being the same. First time I saw that chart, I thought that was remarkable. But the transition matrix that showed movements from taxable to loss and loss to taxable actually surprised me a lot. Most people are on the diagonals, and I thought you'd see a lot more action in that. So that jumped out at me. I mean, I love a good transition matrix, so that was perfect.
There's a lot of discussion about how this has never been tried before, this is new, this is different. But on the other hand, 165 countries have value-added taxes. And are there lessons that we can take from there, those examples or those experiences, to apply to this, even though, yes, this is new and untried?
Yeah, I think so, definitely. We know that we can administer value-added taxes. The equivalence in theory does not mean equivalence in the design and implementation of the tax. Yeah. And for a variety of reasons, that credit invoice VATs, sorry, let me take a step back. There's two ways to do a value-added tax. There's the credit invoice, which is the way 160-some countries in the world do it. Mm-hmm. And there's a subtraction method, which is the way Japan does it. Right. This is a subtraction method. The credit invoice method works better along a variety of dimensions, and some of the issues like the refunds that you give the exporters, that's done on a monthly basis in a VAT, whereas here it will be done on an annual basis when a firm files their tax return. So I think we know that a credit invoice VAT is administrable, but we also know it tends not to end up being as clean as the cash flow tax looks on paper.
Yeah. Doug?
So I think I'd agree with some of the administrative things, but I think a problem with the discussion so far is that we may be trying to learn the wrong things from some of these previous experiences with adopting VATs, border adjustable VATs in particular. There's an enormous amount of interest, as Bill mentioned, about the currency response to the border adjustment. And so if you think about the conceptual experiment, the idea is we go to the first line in all those tables, which is an origin-based cash flow tax. And then we decide second to border adjust it, and because you're exempting exports at that point, taxing imports, you would expect exports to become more valuable. People want the dollar goes up. People want fewer imports, they supply fewer dollars to purchase the currencies to get them. Both of those put upward pressure on the currency, and a couple of things jump out in the sort of standard thinking about this. Number one, your currency does adjust to offset the tax. So an importer, say the retailers that are so worried about it, go from having a cost basis buying a pencil from Korea of $1 and then selling it, and they end up with a cost basis of 80 cents because the dollar is stronger, they can buy it cheaper, plus they have 20 cents in tax. Their cost basis per se is unchanged, their after-tax profits are unchanged, their pressure to raise prices is zero, but they have a really big tax increase. So like this is what I said, the conceptual experiment they did is what the tax department did. They took a look at the House reform and they went, oh my God, our taxes are going up infinitely rapidly. This is unbelievable. But that's the wrong question. The question is, what do you make after tax? So that currency adjustment is the important thing. No one has ever done us the favor of actually adopting a VAT, waiting a year, and border adjusting it so that we can see the currency adjustment, which is a one-time, other things equal change in the valuation of a country's currency. It is not the claim that the dollar will be 25% higher forever as a result of the adoption of something like this. It's that other things equal, it will be 25% higher to offset this particular piece alone. The rest of the House tax reform should have dramatic economic consequences. This is a movement from a tax system that prefers foreign production to domestic production to a tax system that's neutral with respect to location decisions. That's not a neutral change. It's a movement from a system that has depreciation allowances by and large to one that does cash flow. It's one that favors equity or debt over equity. It's one that's neutral. All of those things should affect the fundamentals in the economy, affect the real exchange rate, affect the current count, and those adjustments are real and may take some time. They may take 2, 3, 4, 5 years. The other thing is an easily priced one-time transaction in currency markets, and I am quite confident that the traders up in New York can figure it out. So looking at the historical record, those two things are mixed together, and it's going to be very hard to settle this debate. In terms of the mechanics of this, I also think that some of the concerns that Bill raised are overstated. If you think about this supposed wealth transfer, well, it's real, it's a wealth transfer. It assumes that people just sit idly by with their money parked in euros while the U.S. passes a tax reform in the House, passes a tax reform in the Senate, sends it over to the White House for signature. And nobody's going to do that. The moment this becomes even a little bit likely, they're going to start thinking about moving their money. The minute it passes the Senate, all those assets are going to flow into the U.S. wherever possible. That'll give you the adjustment very quickly. You'll see this big capital market inflow, and it'll minimize the hit on people's overseas holding of wealth. It's the same thing that emerging markets should be doing in anticipation of this reform. If they've got dollar-denominated debt, it is time to refinance, folks. I mean, you can't just sit there and get hit. And so I think there are behavioral responses that one should expect that minimize the impact of such a change. And we've seen, thriving retail markets in the 160 countries that have VATs. We've seen the dollar go up 25% over the past 18 months, and the world hasn't melted down. And my expectation is that if we did this tax reform, it wouldn't melt down either.
I want to get to the issue of who bears the burden of the tax, and there's a quote in the paper I want to read. I do want to mention that we will be able to take questions from you all. I do want to make that available. We have two people standing on either corner with microphones, and just raise your hand, and you may have to actually walk out to the aisle in order to ask your question. Sorry to have you do that, but there's no cord on the microphones. But to get to this question of who bears the burden, and we're certainly hearing this from, this is, I think, one of the bigger debates in here. In the paper, Elena, you'd say, one implication of this is that while importers or retailers collect and remit the tax, they generally do not bear the economic incidence of the tax. That is important to keep in mind when examining how the base of the cash flow tax expands with the border adjustment. I wonder if we could kind of tease that out a little bit and just talk about the difference between sort of the legal incidence and the economic incidence.
Right, and so I think baked into the paper and in the response is to keep in mind you need to think about how the imports and exports are concentrated at the firm level. So if you think the firm is only importing, that's going to be a different answer as to what the burden is compared to the firm that's importing and exporting. So if those things are offsetting each other, then the firms are not really changing their position relative to the income tax. And so the truth is that we actually can't get at that because of the way that we were forced to do the imputation. We sort of imposed that neutrality because the census tables indicated that in aggregate, the exporters are also the importers. And so the result of our microsimulation bakes in sort of this neutrality because we assume that the big firms are exporting and importing, and these things are offsetting each other in the data. And so unfortunately, our study can't get at that because we don't have the micro data on the imports and exports. But if you think that you really do have a farmer and you have a baker and they're behaving differently, then it'll be a very different question of incidence.
Oh, because we hear that a lot. You know, hey, the cost of my goods are going up 20%.
That's
you know, my customers.
Yep.
I'm buying coffee beans.
Right.
There's nowhere else on earth or in America to buy coffee
Right.
beans. By definition, this is going to
Right.
fall on them.
Yeah.
And
Right. But I think
I'm
Doug's point
having a
about
hard
the
time getting around
exchange rate movement is also very important to keep in mind when you're thinking about that.
Yeah.
Because if you think the dollar is appreciating, then you're able to buy your coffee beans
Cheap.
you know, cheaper with a stronger dollar. And so that's all going to be the behavioral responses, which again, what we did doesn't have any of that in it, unfortunately. And so we can't
Right.
put dollars or numbers to that in the way that we would like to.
Scott, here's a way to think about that. Let's assume the exchange rate adjusts fully. So there's no change in net of tax import prices, net of tax export prices, as Doug was talking about. Then there's two things going on here. One is we've been talking about the cash flow tax, but the first thing that's happened is the corporate income tax is disappearing. And then the cash flow tax is being added. So you're removing the corporate income tax. The corporate income tax, there's a lot of debate about who bears the burden. It's clear that labor bears some of the burden, capital bears some of the burden. It's not clear how much of the capital burden is focused on the shareholders per se versus all capital holders, but there's a mix there. You're removing that tax. You're adding a cash flow tax. The cash flow tax is a tax on consumption, but it exempts consumption financed by wages, right? And it exempts the normal rate of return to capital. So it's only taxing consumption financed by the supra normal return to capital and past investments, right? In the transition and past investments going forward, it's just on economic rents. So in principle, it's a very progressive tax. That's if the exchange rate adjusts fully. If the exchange rate doesn't, then it's much more complicated. And if import prices go up, then you've got to figure out who buys imported goods. There's some evidence that that's disproportionately low-income households. But a lot of it depends on the exchange rate. But I would just emphasize that we're not only talking about introducing a cash flow tax, we're talking about repealing the corporate tax. That's not how it's written in the blueprint, but functionally that's what's going on. And that has important implications. For example, I agree with Doug that the overall impact of the package would be to raise the exchange rate because forget about the border adjustments for a second. The other stuff should bring in capital to the U.S.
Mm-hmm. Doug, any thoughts?
I'd agree. I mean, you know, the typical, if you get rid of the corporation tax, then yes, what happens if you impose a consumption-style tax? Bill's exactly right. It would be non-wage finance consumption from domestic sources, and it's a one-time tax on existing wealth, in this case, held overseas, if you continue to do it. And so we know who those people are. The people have fancy international portfolios and supernormal profits, and they're not. This is not the sort of low-income working stuff. This is so this is a very progressive tax in its incidence.
Hold up your hand. Yes, sir. Why don't you step forward?
Hi, it's Victor Fleischer from Senate Finance. First, I want to congratulate Elena. It really is a terrific, really useful contribution. So thank you for that. Lots of interesting stuff to work with on that. My question is for Doug on the currency adjustment, which is a new issue for a lot of us in tax policy. We're hearing a lot from constituents and from there's some research notes coming out of Wall Street that are skeptical of the how complete the currency adjustment might be and how long it would take. So what's your explanation? Is it just that you don't think Wall Street can understand it yet, or do you think that with time they will get it and we'll start to see the adjustment in the markets?
I think it's because they're combining the two things. The notion of the complete adjustment of the exchange rate is really targeted just on the border adjustment. And as a footnote, I'd point out, in the House blueprint, there are two rates that matter. One is the corporate rate of 20%. That's been the focus today in most discussion. But the pass-through rate is 25%. The pass-through base will be border adjusted as well. And so if all of the imports and exports came through pass-throughs, you'd need an adjustment of 33%, not 25%. And the world will consist of some combination, weighted average of those two. So I don't even know what exactly perfect currency adjustment means in that context. But so go back to just having the 20% rate. I believe what they're doing is exactly what I described. They're looking as they should, to previous experience. What happened when Australia adopted a VAT? What happened, in all these different settings? And the answer is two things. There was the border adjustment impact, which should be a one-time and, in my view, quite quick currency response, and then a deep reform to an economy which has fundamental changes to the investment incentives, the allocation of capital, maybe even labor supply incentives, all of which take time to phase into their steady state, and which will also affect the exchange rate. The latter are slow and of ambiguous magnitude. The border adjustment's not, and of a very concrete magnitude, and they get them mixed together. I think that's all that's going on.
Can I follow? I think there may be more going on because the rest of the plan should raise the exchange rate. The border tax should raise the exchange rate. So the combination should be bigger than the border adjustment. But the Wall Street guys are saying it's less. And so, everyone I've talked to from industry and finance says I think it's going to be less. Every academic, myself included, thinks it's going to be basically the border adjustment's going to result in close to full exchange rate adjustment. To me, it's still a puzzle why they're saying the combined package effect is less than just the full border adjustment. Whereas, as I think about it, it seems like it should be more than the full border adjustment.
It's also a slightly incoherent set of research notes because they go through and they say, this is true, like what Bill just said, it'd be less, whatever. But you better get out of your emerging market investments because they're just going to get hammered by this thing. Both can't be true simultaneously. And so either it adjusts and you worry about the emerging markets managing their dollar exposure, or it doesn't and it's a non-event. So I'm confused.
As a general caveat, can I just add it? There's a lot of this going on where someone will say, well, X, Y, or Z is going to happen, and if you think about it, that depends on the exchange rate adjusting. And then someone else will say, well, and then the same person will say ABC is going to happen, and that depends on the exchange rate not adjusting.
Right.
And they can't both be true at the same time. So keep as you're thinking or hearing stuff about that, pay attention what Doug just said, is because we don't know fully the effects, there's a lot of inconsistent assumption making going on.
We have a question over here, sir.
Yes, Ralph Galliano. I'm the project director of the Freedom Tax at thefreedomtax.org. My question is, isn't the border adjustment tax, which I think you've already described as a quasi-value-added tax, not unlike Senator Cruz's corporate tax plan, which the Wall Street Journal did label as a value-added tax? So, since the plan introduces a new tax into the system, an individual income tax plus now a value-added tax, means introducing the camel VAT nose under the tax tent?
Well, if I could step in as the moderator's prerogative, as Bill just mentioned, this is replacing the corporate income tax for all intents and purposes. So we have two taxes now, and so this is replacing one with the other, I would think.
With all due respect, actually, we have one tax, that's an income tax, one on individuals, one on corporations. What we're doing here is adding a new tax, i.e. a value-added tax.
Yeah. Our entire tax system is a bit of a hybrid in many different respects. You know, we also have savings plans, which make it a little bit more of a consumption, and we have near full expensing, or at least 50% bonus expensing, which moves in that direction. So in all intents and purposes, we do have very much of a hybrid system. I don't know if anyone else wants to...
This is a close cousin of the X tax that was developed by my late Professor David Bradford, and the author of Blueprints for Basic Tax Reform, the sort of starting point for this discussion in the US. And the reason he called it the X tax is he thought it would be really useful if people didn't label it either an income tax or consumption tax or a silly tax or whatever. They would just look at the tax and ask the question, what's going to be the economic impact of this tax and what will be the incidence of it? And I think that was a good admonition and we should stick to it.
We have time for one more. I know we're getting pretty close to the time I had promised to cut to begin. If you could stand up.
Sure. Thank you. My name is Caroline Kitchens with R Street Institute. Thanks to all of the panelists for their comments. I was just wondering if you could elaborate a little more on whether or not we should include the F-base when we're designing a policy. So I know in your study you mentioned that most of the other countries with valued-added taxes do exempt financial services. So I was wondering if you think it would be wise for us to do the same in order to level the playing field, and if you could speak a little more to that.
So I'll start about just why we excluded the financials. So that it's just a very complicated question, and so without further input from policymakers on how they view the financial industry and what to do with it, the truth is that the tax data that are available right now don't make it easy to identify the financial transactions. From a simplicity perspective, R plus F is a simpler tax to administer. But when you're thinking about only businesses being contained within the cash flow tax, if you exclude financials in an R base, then you have to deal with financials that move directly to consumers, so a bank that's making a loan directly to a person. And so the second that you do an R base except for business to consumers, you're stepping back a little bit from the argument that supports a cash flow tax from a simplicity perspective. So there are reasons to do an R base because tracing financial transactions can be very complicated, but once you do that, you sort of lose the simplicity argument of the cash flow tax. So it's a bit of a chicken and an egg there in terms of which direction you want to move.
Can I add one thing? The other countries have a corporate income tax as well as a value-added tax. So even if they don't tax the financial sector under the VAT, they're captured under corporate tax. This would replace the corporate tax. So if we didn't tax the financial sector here, there would be essentially no tax on the financial sector. There are ways to tax the financial sector under VAT. It's just tricky. One of the ideas is to simply just tax the wage bill in the financial sector, because wages traditionally are like 70% of value added anyway, and you can observe wages. Financial value added is just harder to measure.
One last question. I want to slip you. You had your hand up quite a bit. So.
Ramos, my name is Luis Vega Ramos. Hello, I'm a state representative from Puerto Rico, and I was wondering if, as some of you may know, certain U.S. companies operating in Puerto Rico for tax purposes are Section 901 corporations, which means that their operations are considered foreign operations, and thus they're exempted from federal corporate income tax law for those operations. I was wondering, as this discussion moves forward, what thought and what alternatives, if any, has been thought of as to how to consider the imports that would come from U.S. territories such as Puerto Rico and others in terms of the border adjustment tax. How would the imports coming from Puerto Rico, Virgin Islands, Guam, and other possessions or territories would be factored in as either imports within the United States, or would be considered as foreign imports, such as in case of particularly Puerto Rico, some of those companies are considered foreign companies for federal tax purposes. Thank you very much.
So I think taken at face value, the answer is pretty straightforward. Those transactions will be classified as transactions between a U.S. company that's foreign sub. Thus, the exports will not be subject to tax, the imports would. And the issue becomes, do you want to retain that as the legal tax treatment, or do you want to identify those operating in Puerto Rico as operating within the United States, and thus just pure domestic transactions, not border-adjusted ones?
Elena, tremendous work. Congratulations to you and your colleague. And Bill and Doug, thank you very, very much. Let's have a hand for everyone. Thank you. Thank you all. And we look forward to seeing you at our next event in just a few weeks. Thank you very much. Have a good afternoon.